Thank you, everyone, for attending. We have Kimberly Morissette with Huth Thompson here with us today, and she's going to explain some of the complexities of the employer retention tax credit. So again, thank you and welcome, Kimberly.
Hello, everyone. Good morning. As Mark said, I'm going to discuss the employer retention tax credit. I like to use acronyms, so you'll hear me reference ERTC quite a bit. This is a very complex actual tax credit. And I'm going to talk to you basically about a high-level overview of this actual credit. It's complicated enough that I really think you need to reach out to your CPAs, your payroll people, your experts in your arenas to actually walk through this credit with you. But today I'm going to give you a bird's eye view of this. So what is ERTC? And I believe you all have access to the slides here, and I will be following those. There's a couple nuances you have to understand first and foremost. It's a fully refundable payroll tax credit. So this is not something you're going to claim on your income tax return. So it's not that you're going to run to your income tax return and say, I need to amend this. This is a payroll tax credit. The rules are different for 2020 and for 2021. This is where the complexity starts to creep in. In 2020 is what I'm going to first talk about. The credit equals 50% of qualified wages. Now that equates to basically you get to take $10,000 of qualified wages per the 2020 year, and you get a 50% of that as a credit. So you get $5,000 per employee. Sounds great, doesn't it? Well, let's keep going. It includes health plan expenses, things you as a business owner pay for health insurance for your employees. So you can add that basically into that wage bucket. And they started this credit in March 12th of 2020 through 12/31/2020 for the end of the year. Now, previously, before we got to the end of December, before Trump exited office, he changed the regulation that allowed everyone to take this credit even if they received the PPP, Payment Protection Loan. Before, this credit was there back in March of 2020, but no one was taking it because they couldn't under current regulation. Now with 2020 and the Trump reclassification bill the end of December, we are able to actually take that credit even if you receive the PPP loan. So let's look at 2021. The pot becomes sweeter. So bottom line is you get a 70% of qualified wages for this ERTC. Now you look at basically quarter by quarter as far as a maximum $10,000 worth of wages paid per quarter, and you could get a $7,000 credit per employee. Now this also includes that you can add health plan expenses to this. And this now goes all the way through the entire year. When Biden came in, he said it went through June 30th. Now guess what? He's extended that all the way through the end of December. Now, so that was 2020, 2021, look at the whole year worth of wages. Now the number you need to remember is this, $33,000, okay? And this is how this equates. There's $5,000 per eligible employee basically in 2020 you could receive. Add to that for 2021, if you qualify, you get $7,000 per employee per quarter equals $28,000 for the 2021 year. Add those two, the 5 and the actual 7 times 4, which is 28, you get $33,000. It is possible that you could get $33,000 per employee for these 2-year period, okay? Now, there's a lot of nuances and we're going to get into that. So how do I know if I qualify? Who is an eligible employer? Now, there are 2 caveats here, and it's an or, it's not an and. So you have to make sure that you are actually looking at this as an or. 1, you could be fully or partially suspended operation in any calendar quarter by a governmental order for COVID. Now remember, this credit, you're going to hear a lot about quarter by quarter by quarter. It's all calculated, or if you're looking at suspended operations by quarter. So you could meet the criteria for 1 quarter and get the credit for 1 quarter, not the full 33, but you could get partial of that. This is the tough part of this whole credit, is what does fully or partially suspended operation mean? This is the gray area. This is the area I as a CPA do not like because bottom line is there's a lot of room for wiggle here. And we're going to get into some examples. So that's one way. If you were partially or fully suspended operation, you qualify. Or if you didn't meet that, you might qualify under a significant decline in gross receipts during a calendar quarter. And we'll get into the calculation. I like this one because it's black and white. I do a calculation. I don't have to say anything gray. So let's talk a little bit about fully or partially suspended operation. If the government, meaning the mayor, the state, the feds, CDC, HHS, Health and Human Services, if they said you had to lock down or you had to close, you qualify, okay, under fully or suspension, partially suspended. If you had to continue all of your operation, but there were some areas that really you had reduced revenue, or you didn't have typical operations, or if the closure of that workforce caused the majority of your operations to be suspended, you would qualify. Remote work, telecommuting. This is a tricky one, and this is where the gray area starts in. All right, I have a CPA business. I own a CPA firm. I send all my employees home, but we didn't miss a beat because everybody worked remotely, worked tax season hours. We were right there getting everything done. I don't qualify under fully or partially suspended because my operation was full bore. There was no part of my operation that was really suspended. Now, think about software companies that employ people all around the world to do their software programming development. They can do that from their homes, and they do that. They did not miss a beat. They would not qualify. But think of basically if you had a supplier. We'll get into suppliers. I'm a supplier. And guess what? I have a line, okay? I have a manufacturing line, and on that line, I can't get 5 or 6 things to make my widget, let's say. If I had to shut down part of that line, if I had to wait for supplies to come in because of COVID and I had to send my workforce home, you qualify under partially suspended. Restaurants are the easy ones. Restaurants. My dining room was closed. I could not open my dining room because of COVID. I had to go to actual carryout. You are partially suspended. Even when the government said you can reopen your outside dining rooms and eat outside, but your indoor was still closed. Your kitchen was the only one operating. Your waitresses and things like that may not have come back full bore. You're partially suspended. Again, I think the trickiest one is going to be that remote work telecommute, because if you have the majority of your operations that you can do remotely, were there enough of them really to say, yes, I did not have XYZ program because they could not be done from home? That's the gray area. And that's the one, us CPAs, we will pull all the examples from the IRS. We will help you, guide you through this. But at the end of the day, you need to determine basically if you meet the criteria of fully or partially suspended. So if you don't want to go that route, I always start with this one. I have a client that I basically just did the other day, and I said, I'm not even touching the partially or fully suspended. I'm going straight for significant decline. And let's see if we meet that from this perspective. Again, you have to look at this by quarter by quarter. Gross receipts. So when you look at your gross receipts for a business, it's total sales, all right, less allowances or discounts or returns that you have. So basically gross sales, plus all amounts received from other sources. So if you have, rental income or something else that qualifies as gross receipts, your investment income, your dividends, your interest, royalties, annuities, basically look at your gross amount on your P&L, and that's going to be what you utilize. It does not include cost of goods sold. So when you talk about net sales, you usually say I put cost of goods sold in there. It is gross. It is not including cost of goods sold. That's where a lot of people are tripping up and they're saying, well, if I factor in my cost of goods sold, sure, I'll meet this. No, that's not what's happening here. So you look quarter over quarter. You look at 2020, you had to have a less than 50%, basically less than 50% of 2019 quarters of revenue. And I'm going to give you an example of this because it gets kind of tricky. So you were 50% basically off your revenue mix between 2019 and 2020. That's an easy one. Now, in 2020, the IRS and those in the actual government have allowed us basically to continue claiming that credit until you get greater than 80% on that calculation, okay? So if you had, if you were 50% and then you went up to 70, you still could claim it until you got to 80 for the next quarter. In 2021, they kind of sweeten the pot a little bit, and they say if you're only off 20%, you can claim this credit. So there's differences in how much of your gross receipts is met or how much is off. The other thing I want to point out is that aggregation rules, and this is where it is very, very tricky. And this is where if you have a brother-sister company, if you have a controlled entity, if you have identical owners or similar owners between companies, you need to read the aggregation rules, because in a nutshell, what it says on aggregation, it says you have to aggregate all of those gross receipts to see if you meet this. You have to aggregate all of your equivalent FTEs, your full-time equivalents, as far as employees are concerned, and you have to determine if you met it from that perspective, and you file basically as an aggregate. This is very icy-dicey, as I like to call it, because there's a lot of rules that actually the underlying regulations deal with healthcare and how you calculate aggregation rules for healthcare under the Obamacare and things of that nature. They're not necessarily the exact IRS income tax aggregation rules. So again, think about this as more of here's payroll and HR, and here's medical definitions under Obamacare, not so much here's IRS code. So you have to be careful on that front. So if you have an example of this basically is if you have a company that's your operating company and you have a leasing company that owns that business or that leases some of that entity or that building, you need to make sure, because they're probably common owners, you need to make sure you aggregate those employees and the actual gross receipts. So again, significant decline, looking at an example, because it's easier to see basically what the IRS is talking about here. So you'll see here for 2020, we looked at 2020 compared to 2019's gross receipts. 48% calendar quarters less than 50, so it's 50% off basically or greater off. That quarter you would claim it. You get to claim the second quarter because the second quarter is where you actually increase to that 80% threshold. So you get to claim it for the second quarter. The following quarters, you're over that 80% or over the 50% threshold as far as 2020 is concerned, you're not eligible. So you could get claim that for the first 2 quarters of 2020. And remember, for 2020, the maximum amount for the year of a credit is $5,000 per employee. Then 2021 changes. First quarter, basically you look at 2021 versus 2019. It's not compared to 2020. It's almost at 80. It's almost, 20%, 30% basically, or 20% off. You basically get to claim that. So bottom line is you get to claim that until it goes 80 and above. So you would have that and you could go on for the next quarters. You would claim, second quarter, third quarter, fourth quarter. So that's just a definition in a number format of what has changed between the 2 years. Now, we determined, so you basically sat down and you said, okay, I know what the credit is. I am knowing I'm eligible under one of those 2 eligibility criteria. I looked at gross wages. Let's say I met at gross wages. Now you got to figure out what's qualified wages. Now there's a lot of nuances in the aggregation rules, is what I explained before. There's also a lot of nuances in the large employer versus the small employer. You have to look at your FTEs, your full-time equivalents. And this is basically defined as looking at your 2019, where an employee averaged at least 30 hours of service a week or 130 hours a month. And that average FTE is calculated each calendar month. Now, you look at this and you say, okay, if I'm a small business, I probably have under 100 employees. Great, because that's a sweet spot in this credit if you have under 100 employees. Now, what happens if I have between 100 and 500? For 2020, if you sent people home and you had some people that were actually working from home producing a service for you, if you were in that 100 to 500, more so larger employee bracket, those wages of those people providing services for you at home would not qualify for this credit. Under 100 employees, it didn't matter what you did from home, they qualify. So coming into 2021, that was 2020's rule. Coming into 2021, as long as you're under a 500 person FTE employer, you don't have this restriction anymore on this 100 to 500 bracket. You could have had all of your employees home and providing services and you still get the credit. Now, I think why they changed this is because in 2021, people are getting back to work. This is not going to be as much of a credit, even though they lowered that 20% threshold versus 50% whole threshold. Who actually is, working, not working now is a different story. So you have to determine what bracket you are more so in the 2020 year. And fortunately, most of the people I think on this today are small business, so they'd probably be under the 100. So then what do you do? So I figured out all my wages would qualify. You basically have to figure out the eligible wage calculation. And in this, you basically take all your gross wages by quarter by employee, and you have to back out the PPP loan forgiveness wages you used. This is the big nuance that a lot of people are going to say, oh, I qualify, great, let me do this. And then they realize, wages, I used wages for PPP. You have to reduce those from your eligible wages, from your gross wages. Then you may have some other credits that you use, such as from the CARE Act, for the FFCRA, the family medical leave, et cetera, that you need to back off. And your payroll people are going to know if you took those or not. Those become the eligible wages for this credit. So the things that I want to kind of rehash here from this perspective that you need to know: determine your eligibility. What does that mean again? That means either gross receipts are met, and remember those thresholds change year by year, or remember it's an or, not an and, you have a partial or fully suspended operation. I would suggest you consult your CPA first and foremost to determine if you even meet either one of those criteria. If you do, let's say you do meet the 50% for 2020, obtain payroll records by employee by quarter. Now, I will tell you, I work with a local payroll service quite extensively, and they have got these all populated in their computer systems, basically to spit out quarter by quarter the employees, the gross wages per the employee, and if there were any payroll credits that they already took on those employees. They may not know, though, and they will make you fill it out, how much of those wages did you use for your PPP loan forgiveness? Now, if you have not submitted for forgiveness or you're on round 2 of PPP, the one thing that you need to try and maximize, especially on this front, especially with number 2, there are forgiveness procedures that allow you to use rental fees you've paid for rentals, allows you to use utilities on the PPP loan forgiveness. Use that percentage threshold to the max first before you use them for payroll dollars, because you get your biggest bang for your buck if you can use less on your PPP loan forgiveness for payroll, and if you qualify for this credit. But that's why these work kind of in tandem, especially on this PPP number 2. Because if you haven't sought forgiveness, which a lot of people obviously haven't because their clocks just started ticking, say in January or February, you need to make sure you figure out if you qualify for any of this before you submit forgiveness. And that's where having your CPA kind of go through this with you is very important, or your CFO, somebody that knows your numbers. So then you would obtain your PPP loan forgiveness wages. What you don't want to do is, I'm going to claim this credit first, and then I'm going to go back and claim the same wages. Not going to work, and if you were audited, you would have to return those funds. So once you've figured out, okay, I'm eligible, I backed off PPP, that's where you determine these eligible wages per employee per quarter. Like I said, yes, the maximum you could get on this credit for these 2 years that we're looking at is $33,000. Most people will not get $33,000. But I will tell you, I have a company that has received PPP 1, PPP 2, about 185 grand a pop. And we were able to go back to 2020, and we haven't calculated 2021 yet, but we were able to go back to 2020 and get $51,000 back from the IRS on this credit for 9 employees. So bottom line is, this is very important for the small business to understand it's there. You may not be eligible, but you need to be going through this nuance of this credit to see if you are. So once you determine basically eligible wages, you back off that PPP or any other credits, and you say, here is what I have. So in 2020, you've got $10,000 of wages on somebody, you get $5,000 for the year. Remember, 2020 is on a year. 2021 is quarter, okay? So for 2020, how I went back and got that $51,000 I mentioned on this small business was, you amend your 941s on a 941X. This is where the payroll service is really nice about doing this, as far as they provide you the spreadsheet with the hours and the dollars as far as the employees. You basically fill in your PPP loan forgiveness wages. Here's the eligible wages. You sign off with them. They'll file those 941Xs for you. So that's where it's been very nice to work with a payroll bureau. Now you can file your own 941s, absolutely, as far as the actual amended return if you do your own payroll. In 2021, the ERTC, there's a couple things you can do. One is you can reduce as you go quarterly to fill out your quarterly 941 payroll reports. You can reduce the FICA basically that the employer pays in. So you can do that right on the form. The other option is if you've already filed, say quarter one's filed, and you're now just figuring all this out, you can amend your return. So there's always that amended return that you can always perform. So again, this is a very high level explanation of what you need to do to determine if you are eligible, what qualifies, and how do I get this credit. But it is very, very beneficial for people who are getting this credit. I have another client that is a large operation. They've got close to $500,000 coming back on this credit. It's there, and it will make a difference in their actual business to have that money coming in, because they lost a substantial amount of revenue, and PPP did not make that up for them. So that is very important to kind of maximize basically the PPP loan and the forgiveness side in 2021, because 2020 is over, and what you're actually doing with this ERTC credit in tandem. So the biggest thing, if you didn't listen to anything else, contact your CPA. If you work with a payroll bureau, contact them if applicable for their things. But that's ERTC in a brief nutshell. Yes.
I have a question. So let's say, I'm in partnership with a business with my brothers, actually two, okay? One business took off it was already doing well, but it benefited over the last year. The other one didn't. Now, but do we have to combine that? So then really it's a wash.
We had this happen in our office where we were all hot to trot to get this credit for this company. And then I started reading the aggregation rules. And I'm like, well, if one company, what do we do with this? The aggregation rules are so complex that you have to be careful of what the ownership is. If you've got similar owners to where, one entity, the entities control each other, like brother-sister relationships, you're going to have to aggregate all those gross receipts, aggregate all the FTEs. Unfortunately, it's not just easy.
Yeah. When you started talking about aggregation,
and we thought, okay, aggregation, well, if one of them tripped it. At first, we read the regulation of if one entity would trip it, then it trips it for all. Great, we can file on all of them. And then as I read on and on, that was not the case. And I will tell you, the biggest resources here that I have found is honestly this last one here, the newsroom FAQs, facts and questions basically, and answers from the IRS. The IRS will say it's not authoritative, like it's not regulation, but that is the best resource I've had. Now, the downside to that is they did it for 2020. Everything's based on 2020. And at the top of the page, they'll say, for 2021, this is not applicable. And they'll give you these first two links that I have here, which is the actual code. So it's not as beneficial, but basically, if you know the gist of what changed, the definitions are the same between years. So the examples like I quoted on whether or not you are partial suspension, they're on that last link. And there's more examples on that front. So that's a good resource. And that also, that Q&A basically does talk about aggregation.
Okay.
And it goes through the aggregation. Now, the problem with that is it goes into code in those aggregations.
Okay.
And that's where if you drill down to the code, you get into Obamacare healthcare code.
Right.
And that's kind of the downside to it.
Okay. Yeah. Thank you.
Questions? I'm trying to see if there's any questions here.
Move your pointer to the very top.
Okay.
Oh, okay.
Yeah, Mark, you better look here. Let's see. I see connect to Q&A. I don't see any questions.
Okay. Yeah, you did real.
Well, if there's no questions, let me know. If you have any other questions, I can be reached at Huth Thompson. And any one of us 5 partners are having to get into this credit pretty much daily. So let me know if you have any questions. And with that, I'll turn it back over to Mark.
Thank you all. Thank you, Kimberly. Fantastic presentation, and answered a lot of questions, I'm sure, and we'll continue answering questions as more people view it. Thank you all for signing in, and we want to remind everyone that on May 18th at 9 a.m. at River City Community Center, we will hear Mark Brandyberry talking about unconventional marketing through COVID and beyond, some of the techniques that he's learned and implemented to help during the pandemic and after. So thank you very much. And as always, have a great day and stay safe.